It's okay. You'll get her phone back and everything will be okay.
She'll be okay.
Yeah. And then Tracy can
Wait till
finally
you
be
throw a
rid of
couple
us.
kids in the mix, then worry about your brain.
Long time from now.
Yeah.
I love it.
She wants to get another dog. I'm like,
How many do you have?
1.
Oh.
That's all we need.
You know, 2 is twice as much work.
I
There
tell
you
her
go.
she's the one that takes care of
Your
the
math is
most.
flawless.
Amazing. Can you believe I'm a loan officer?
All right, guys. My name is Robert.
My name is Chad.
We are Bray Realty, and we're here with Tracy Everman. Tracy, you run Tracy Everman team at Flat Branch, and I
Yeah.
accidentally called you senior loan officer, and you got mad at me.
No, I
because-
didn't.
Yeah, you got very angry.
You
She
called me a
was very
senior
angry
mortgage officer,
Sorry.
which is fine. Senior mortgage banker.
Uh-huh.
Yeah, we're a banker. We use our own money.
I know. But that's good. Everybody else should know that too.
Yeah.
You know, they don't have to answer to the man. What does that mean? But yeah, so guys, we are just kind of continuing our idea of educating buyers and sellers. And we've noticed politicians and anybody else trying to grab views or just flatter the public to get more attention have been going off on these tantrums about the lack of ability to afford a home, right? And personally, myself, and I can imagine Tracy and Chad, are just a little annoyed on these concepts due to the fact that it's not necessarily always, and more likely, not necessarily lack of affordability. It's more likely lack of education on that part. So we figured we'd run through some questions and ideas with Tracy with her extreme level of experience, skill sets, and my favorite, critical thought skills, right?
Don't get too critical.
Yeah, well, yeah. But we figured we kind of quiz you on a couple different questions that I
Sure.
think and Chad thought that buyers would want to know.
Let's do it.
Cool. So, Chad, let's just dig in, make it.
Sure. Well, first, Tracy, thank you for being here.
No, thanks
It's
for inviting me.
of
I think
course.
this is going to be fun. Don't
Yeah.
worry, we'll keep it very entertaining.
So why don't you start off, give a small background about yourself, how long you've been in the business,
Oh
in
my
the
goodness.
industry.
Since you were in kindergarten, I think we talked about that.
6 years old.
I've been in mortgage for 24 years.
24.
Long time, long enough
Holy
to
cow.
know better, but still constantly learning new lessons. I've helped thousands of families in the St. Louis market.
Wow.
I've had a lot of lives in the mortgage industry when you go back to look at like the subprime era, the market crash, the market recovery, COVID, now inventory issues, So yeah,
So
been
you've
doing
been
it a
through
while.
lot. Yeah,
Been doing it
through
a while.
lot.
Yeah.
Cool. Well, we'll get into some details, of course. We'd like to hear your opinion and
do my
thought
best.
process behind some of these questions. Pretty straightforward, but we'll get into it. So I guess first, obviously,
What was our favorite question?
what was our favorite
Was
question?
there a favorite? Did I have a favorite?
Well,
They're
no,
all
we put it as one.
They're
Oh,
all our
okay.
favorite. Well, first, obviously, you're a lender, a banker, where you say so. You essentially help, buyers be able to.
I do the money.
Yeah, you do the
I
money.
do the
side of
money.
thing.
People need money to buy a house. You guys do the houses. I do the money.
Yes, exactly.
Yeah.
So there's a lot that goes into, the financing aspect of purchasing. There's a lot of things that you guys look into.
It could get really complicated really fast. I think you guys know me well enough that I try and keep it as simple as possible.
Sure. So I guess in the most simplest terms, I guess go into some detail, but how does a lender like yourself actually determine how much someone can afford?
All right, here we go. Okay. The way I like to explain it, especially to my first-time buyers, but even people who are, they may have not taken out a mortgage in 15 or 20 years, is that
Yeah.
the mortgage, okay, it is the largest amount of money that you are going to ask to borrow, period. Okay, getting a car loan, that's one thing. Getting a mortgage, and it doesn't matter whether it's $150,000, $200,000, $600,000, $2.3 million, whatever the number is, it's a lot of money. So basically, I just have to prove if we give you the money, you can pay it back. Then how do I prove that? Well, by way of the mortgage application eventually, but we talk about things like where have you been living, where have you been working, how is your income, how's your debts, what's going on in the bank accounts, how's your credit. In those 3 areas, meaning like as long as you've got gainful employment and income and your debts aren't out of whack, that's 1. You got a little chunk of money in the bank, that's 2. It takes a chunk of money to get an apartment, right? So a chunk of money in the bank. And then number 3, how's your credit? And we all know if you pay your bills on time, your credit's probably okay. And if you don't pay your bills on time, guess what? Credit might not be so good. But your credit score, which we may have a question on that, like your credit score literally is, it shows your ability to borrow money and pay it back.
Okay. So when if a buyer came to you and they were like, I don't know where my credit is at, I always have buyers come to me and they're thinking, my credit's at this point, I checked, Credit Karma, and then they always go to the lender and they always come back to me super sad, upset. And elaborate what I guess you would say Credit Karma is doing, or any of these credit shadow companies that I think of, and what actually happens when you look into it.
Very reasonable and logical explanation for that. So what consumers see, is a consumer score. Mm-hmm. Okay, so you've got Credit Karma, you've got your Discover card, you got Bank of America, you got Capital One, even like Equifax.com or what have you. They can spit out a credit score, okay? And we call that a consumer score. But that is not the score that a financial institution is going to use to base our decision on, will we give you $400,000, okay? And where credit reports for financial institutions come from are actually called repositories. And there's about 5 or 6 of them in the entire country, okay, that financial institutions, bankers, specifically mortgage bankers, that we use. And those are the actual, data warehouses where creditors report, yes, they made their payment on time, okay, or no, they're in collection.
You're talking about FICO?
Yeah.
And
yep. There's 3 different scores, 3 different bureaus, TransUnion, Experian, and Equifax, okay? And the reason the 3 scores are different for most people is because they use different software, okay? Matter of fact, little secret here, there's a slight overhaul going on in the entire credit scoring model right now.
Vantage score?
Yeah. And
4.0.
so when we might actually go from 3 scores down to 2, but that's all to be determined, if you guys can imagine revamping the entire credit scoring model. But no, so repositories are where we pull the truest, we call it a tri-merge credit report. It is the truest, most accurate credit report, credit data, and credit score that we as a financial institution can get. And here's my little analogy, because I have this conversation. I'm so glad we're recording this. I've told 10 people this week, I'm like, I have got to make a video talking about consumer score versus
We'll send you this
true
footage
score.
right here, and
Thank
you can.
you.
Yeah.
We need to
We
clip it
charge
out.
a premium though.
Okay, all right, 50 cents. There you go. Anyways, but I always tell everybody, I'm like, listen, looking at your credit score on Credit Karma is kind of like looking at your home value on Zillow. It's a good start.
Yeah.
It's a good start, but it's not the real true
That's
analysis.
why I always call it a shadow.
Yeah.
Right. It's best they can do with the lighting that they have, but it's not the real you.
Yeah.
It's the best impression we can get.
Yeah, right.
Yeah.
It's a good start, though.
Oh yeah.
So
I mean, no, I'm not downing Credit Karma or any of these companies. Probably shouldn't keep identifying them. But any company, Capital One, I can think of 100 that do it, and they do it very well. Mm-hmm. But definitely important to understand that number can change drastically, and you do need to spend some time.
we would never give money based off of a Credit Karma credit score.
Yeah, and I don't think they would want you to either. They wouldn't want to be held accountable to that.
If I give them money, can you pay it back? Let's prove it.
So I don't know, are you comfortable giving a number that maybe your firm, and you can say I'm not comfortable giving this, of what a minimum credit score you guys would
Oh
be
gosh,
like?
okay.
Yeah.
So I like that you bring that up, because there was tons of media last year in 2025 about, there's no minimum credit score, for Fannie Mae, Freddie Mac. They're basically like the big mortgage agencies of America, is how I explain them. They provide mortgage money for, 70 to 75% of the home buyers out there. But anyways, where were we? Forgive me.
No, we're just
Okay, the
talking
minimum
about-
credit score. Okay,
Yeah.
so our minimum credit score at Flat Branch for any financing is 580.
580. Okay, and compare yourself to maybe 10 other lenders that somebody might go to elsewhere.
Yeah.
Would you say that's pretty much
I
of a
think
standard
that
idea?
banks, your traditional banks, their credit scoring requirements are a lot higher
I thought you were a
Okay.
bank.
than 580. Well,
She lied
so
to us.
there's banks, then there's mortgage
lied.
banks, then there's mortgage brokers, but that's a different podcast. So, no, so everybody has a minimum. I think most of us, like mortgage bankers, those of us who do only mortgage, I think 580 is kind of the line in the sand. But then, like every different type of program, down payment assistance, they also have their line in the sand. There's certain requirements for certain programs. Yeah, 580.
Cool.
And
I like it.
obviously, we're talking about credit scores. So you have the minimum. How does your credit score? How does that impact your rate? You know,
Oh my gosh,
you go to
it-
580. It
It definitely does
Right?
because your credit score's 580 for a reason.
Yeah.
Something, and it's not lack of credit. 580 happens. Anything below, say, 620 or 600 happens because life happened. There's
Yeah.
a late payment. There's a collection. There's something.
Oh, yeah.
It's not anything you can't recover from. Yeah,
course.
everybody can recover from it. I recovered from it after the market crash. I lost 90% of my income in 2008.
Can't imagine how fun that was.
Again, another podcast. So.
Yeah, and on top of that, I think it would be strategic not to get in depth about how it affects your actual loan. That is a whole nother podcast.
Yeah.
Because we could go to town.
We could go for hours.
Yeah,
But
so-
yeah, credit score definitely affects interest rate because interest rate specifically for like conventional financing, Fannie Mae, Freddie Mac, is very much, the interest rate is very much dependent on credit score and down
Yep.
payment. The higher the credit score, the higher the down payment, the better the interest rate.
True.
And they have like a benchmark. And the benchmark, if you want to share it, conventional financing, if you're 780 or higher, 780 credit score. You know how long it takes to get a 780 credit score? So if you're 780 or higher, there's no rate adjustments. And if it's 30% down or more, there's no rate adjustments. But that's where the rate adjustments start. So yeah.
Interesting.
Crazy.
And credit scores also, determine which loan program would we suggest
Exactly.
somebody uses.
Whether that's FHA, conventional,
I usually say when it's like 680 or lower, FHA is going to be the better option.
And we'll get into some of it too, but I'm sure there's some down payment assistance or some programs out there that are also utilize certain requirements, so lower credit scores.
600, 620, 640, yeah, always
Yeah.
brackets. Sure.
Okay, cool. So you mentioned, after my first question, you mentioned something their debt was out of whack. I'd like you to go in a little bit more detail on that because we had the credit score. Obviously, you look under the hood, you see, their employment,
One of the three components.
how much, their income, all of those, but when we talk about debt, there might be a little bit of, I don't want to say confusion, but it's not as black and white all
Again,
the time.
try and keep it simple, okay? Let's just say one of your friends comes to me and wants to buy a house. And they make $6,000 a month, okay? $6,000, they're making $72,000 a year.
Yeah.
$6,000 a month, and they have $3,000 in debt by the time they take on this mortgage. Well, 6,000, 3,000, that's 50%. 50% debt ratio. Anything under 50%, usually we can get through. You start stepping over 50%, you're taking on risk, a lot of risk. So, so it's the income, say 6,000, versus the, $1,500 mortgage payment, $500 car payment, and then $1,000 in student loan payments or whatever, credit cards.
So your
You know?
average consumer, if they were in the office with their lender and their lender's like, you're taking on risk or this is risk, they're going to be too shy to ask, what the heck do you mean by
Yeah.
risk?
Well, it's risk for us.
Yeah. So
Because if we
elaborate.
give you the money, are you going to pay it back? But it's
Yeah.
also risk for you.
Yeah.
I don't want people, you hear the term house poor. You don't want to be house poor and living on ramen noodles. And, I think there are some people that might, put themselves in that situation.
Yeah.
Not many for the record. Actually, most people that come to me actually qualify for more than they're asking for, which
Yeah.
I think is great.
No, it's good. What I meant by like risk is like we communicate and a lot of buyers come in to the lender thinking like, where's my money? How do I get my money? You serve me. And they forget that you guys are a business, right? You're going to go out of business unless you handle it correctly, right? So we
Right.
got these buyers coming in and they're going to be like, where's my money? Why are you having trouble with this? Why are you asking all this different paperwork? It's just the requirement today.
Very simple because you know what? You're asking me for $250,000.
Exactly. So I just want to elaborate. Risk is not to the buyer, which I've had a lot of buyers say, like, what do they mean by risk? Risk is to you guys. You're
Yeah.
like, I can't give you money unless I can see you paying it back
Right.
correctly, right?
So that's the very simple.
And kind of
Part of
backing off
mortgage.
of our last podcast, there's reasons why you get an appraisal done. There's a reason why
Yeah.
you require insurance,
Well,
right?
yeah.
Because you're taking the risk. You better make sure that,
Well, like,
the place is
You
insured.
guys know me well enough, like I'm real.
Yeah.
Guess what? Do you own the house?
No.
The bank owns the house until you
course.
pay them off. And then
Yeah.
guess what? If your life takes a turn and you can't pay the bank back, then what do? They take the house. It's called a foreclosure. So,
Yeah.
so
I
we're the
love
ones in the
idea.
end
Yeah.
holding the bag if somebody's life goes sideways, which is what we
Agreed.
saw in 08. tons of foreclosures 'cause people
Agreed.
lost their jobs.
Oh yeah, yeah. And I mean, I don't want to down the idea. You like when I say you're buying a house, when I say you own your home, even if you have a mortgage through your bank, yes,
Yeah.
I would still argue you own your home. Right? There's some
Absolutely.
states where technically
You're not renting.
Yeah, you're not renting. You are putting money towards your investment. It is your home. The bank
Yep.
can't just come along and be like,
Nope.
"Hey, we're gonna, void this contract. We're gonna do this."
No.
It's an agreement.
That only happens if you don't pay. Which
Yes,
honestly,
exactly.
foreclosure rate right now is the lowest I think we've almost ever seen in history. And it's because getting a mortgage is not easy.
Yeah,
You
yeah,
know?
and people are getting a little bit more strategic with it too, right?
Yeah,
It's not like probably. I can imagine 2023 we probably had a spike in foreclosures simply because people were just jumping into the house without doing any contingencies or inspections or anything and just taking on this
You'd
debt.
have to pull that up in your Maris
Yeah.
data.
Yeah.
I'm not tracking
I'll
that.
pull it up. Yeah, where's the data, Chad? No. But yeah, keep going. Sorry, we're getting off topic.
They're all good.
So obviously, you discussed exactly, the things that you look at when you're essentially going through a pre-approval, at least at first, and or underwriting. Your clients as far as to get them funded
Yeah.
for a property. A big question that we always get asked are, things that have been seemingly, there's a little bit of a misconception of exactly how much money that they should have.
Oh,
as
like
far as a down
for
payment,
upfront
the
stuff.
upfront costs, right?
Upfront
What does
stuff.
that look like?
I'm so
What,
glad
how
you're
much
asking that.
how much money does your average buyer really need to purchase a house?
Well, I mean, you got to have a chunk of money. That's why I say you got to have a chunk of money in the
Oh,
bank,
yeah.
even to get an apartment, right? Because you got to do, security deposit and all that.
Mm-hmm.
You're going to need some upfront money for home inspections. Now, home inspections could run what, $300, $400, $500, or if you can go home inspection crazy and you spend $1,200 on home inspections to make sure it's a safe house. Home inspectors will always know more about houses than we ever will. But you got to have some upfront money for home inspections. If you don't have a down payment saved, that's okay. Like I've got 5 down payment assistance programs. You have the fun programs like USDA, which will give you 100% of the money. You can, if you have somebody in your life who is ready, willing, able, and generous, you can get a gift from a family member. So down payment, the minimum down payment for financing of any kind, if it's not 100% financing. Oh, side note, 100% financing for our veterans. VA loans are the best, as they should be, for the men and women who serve our nation, okay? But 3% down, 3% down. So like if you're buying a $300,000 house, there's $9,000. But again, I got programs to get you that down payment if you need it. The other thing to keep in mind is when you buy a house, it's not just the down payment. What about closing costs, Tracy? Okay. So there's 2 sets of costs when you buy a house, closing costs and prepaids. Again, trying to keep things simple. Closing costs are the human beings.
Yeah.
How many human beings does it take to get me in my house? I ask this question a lot.
I can imagine upwards of maybe 19 to 26.
26 is the number.
Yeah. Is that it?
During a market crash, I was bored, and I'm like, how many people does it take to buy a
Yeah.
house? So I made a list. I was like, oh my gosh, it's like
Yeah.
26 people. So closing costs are the human beings, the manpower it takes to get from start to finish, make the money show up at the table, okay? You don't have to worry about all those people. Your realtors and I coordinate the majority of those
Yep.
people. Closing costs are the human beings. Prepaids have to do with the expenses on the house. When you buy a house, there's expenses, right?
Of course.
What are the expenses?
Inspection.
Well, no,
Well,
I'm
she's
talking about the expense
taxes,
of the house. Yes.
insurance.
Home
Gotcha.
insurance,
Yeah.
taxes, real
Oh, yeah.
estate taxes.
I see.
So the day you buy your house, guess what? You have to put a home insurance policy in place. That could be $2,000 right there, just
Yeah.
for home insurance.
Oh yeah. So elaborate on that because not many people realize when they get insurance, they have to proactively pay for the entire year.
Yeah, the
So
day you buy
it's
the
not a
house
fun
is the
amount to have to all
effective
of a sudden-
date.
Yeah.
And that depends on the price of the house. I mean, insurance could be $1,500 a year, it could be $2,000 a year, it could be $6,000 a year.
course.
The higher the price house, the more insurance coverage you need. But
Oh yeah.
so, good ballpark. Let's call it the 150 price range to
300.
$300,000 price range. You're going to need probably a good $6,000, $7,000, $8,000.
Okay. And then how about your first time home buyers, young millennials who are going to be dancing in that 150 to 250,000? It's going to still be kind of along those lines, give or take.
Yeah, and it's 6,000 range.
I can imagine the average millennial in St. Louis is going to probably keeping it around $250,000. And then the deal, the deal hunters, they're going to be trying to look for those $150,000 homes, right?
Well,
Yeah.
the condition of those homes, could then come into question as
Well, that's what
as
I
you guys
mean.
have experienced.
Yeah, exactly. So you mentioned USDA, and I think it's strategic to elaborate on USDA, because when you say, yeah, it'll pay for 100% of the closing costs, somebody's like, man, how do I get one of those? Well, in St. Louis City, that might be a little bit difficult. So elaborate for me on what a USDA loan is.
USDA. Okay. So I always tell everybody, when you think USDA, you're thinking of a New York strip steak, right?
Yeah.
It's the United States Department of Agriculture. Okay. It's farming. And so, yes, it has to do with farming and agriculture, but USDA has a housing program called USDA Rural Development. And so the entire intention behind that loan program, they'll give you 100% of the money. They won't cover your closing costs, but they'll, if you're buying a house for $300,000, they'll give you $300,000. Or if you're buying a house for $200,000, you get a loan for $200,000. Here's an interesting thing for USDA, though, is if the house appraises higher, you can actually roll the closing cost in. It's a side note. But the whole purpose of USDA was to offer a really great loan program, 100% of the money, good interest rates, very little PMI, private mortgage insurance. But it was designed to grow homeownership in rural areas, so the outskirts. And anybody listening, if you're in the St. Louis market, I live in Wentzville. USDA did its trick in Wentzville. I've been there.
Yeah.
Population went from 16,000 to 52,000.
Oh,
so
yeah.
now Wentzville's not USDA eligible. It's very
course
much
not.
based off of maps. So a lot of parts of Jefferson County, St. Clair County, Franklin County, Lincoln County, Warren County, and that's what USDA was designed for. Matter of fact, Flat Branch Home Loans, giving a plug. We are the #1 USDA lender in, let's see if I can remember, Missouri, Kansas, Illinois, Kentucky, Arkansas, Georgia, maybe Texas. We're #1.
Brilliant.
And we're just this little company in Missouri that we've expanded over the overall Midwest. We're #3 in the nation
Nice.
for
Must be
USDA.
proud.
Yeah, we know what we're doing. So
Nice. And you're just a measly loan officer. No, I'm just kidding.
I'm just a mother. I'm just a mom of 3 living in
No, I'm just,
Wentzville,
I feel bad
Wentzville,
still
Missouri.
calling you a loan officer. You're like, hey, get
No,
your
stop.
verbiage right.
Stop it. There's lots of titles.
So we're actually running low on time. I guess we're not running low on time, but there is a lot of good other questions.
Yeah.
But I kind of wanted to segue into the idea. We had a question on there regarding what goes into your mortgage payment. It's not just about, when, your average buyer, when you say, what's your budget? They're going to say, I don't know, $200,000, $250,000. And that $250,000, you put it X area and then put it over in Y area is going to be completely different to you. So,
Well, the overall mortgage payment, we call it PITI.
yeah.
So
Pity.
principal, I know, isn't that funny? We always make fun of that too.
Yeah.
But principal and interest, which is the payback of the loan. Then you have taxes. Then you have insurance. So that is your full payment.
So, and you mentioned earlier that all gets paid up front at the closing table. Can you explain a little bit on how
Well,
that
no.
works?
So the home insurance gets paid the day you buy the house. But every month when you make your payment, principal and interest, taxes and insurance. So the taxes and insurance are going into this thing called an escrow account. Okay?
Yep.
Because your $2,400 tax bill has to be paid once a year. Your $1,800 in home insurance have to be paid once a year. So essentially, and guys, I'm doing math. That's what I do. But, if you take $2,400 a year for taxes divided by 12 months, it's $200 a month. Becomes part of your mortgage payment. You take $1,800 a year divided by 12, it's $150 a month. That becomes part of your mortgage payment. So, that would be $350 a month overall for taxes and insurance. And
So someone that's already working on some sort of a tight budget, a small increase in their insurance quote or costs or their taxes can almost make a pretty big difference
It
in some way,
could.
in some ways
could, I mean,
on their affordability.
$300 higher is $25 more a month.
Well, I mean, it is interesting though, because I bought a house and you were my lender. And specifically speaking to that, we had to pass, because it was a multi-unit property that was more than 2 units, we had to pass the self-sufficiency clause. And you were grateful that I spent so much time weeding those individual dollar bills towards my insurance, right?
Yeah.
Not just taking on the highest insurance price, because you're like, it gets us perfectly in that threshold when it comes to the self-sufficiency clause. We're not going to go into any of that. You could look it up or reach out to us when it comes to what the heck
Google
we're talking about there.
multifamily self-sufficiency clause.
But just speaking to that, when you say, you know, every dollar can count, it can.
Everything, you know,
Yeah.
every part of the overall mortgage payment counts.
Oh, yeah.
What is the loan amount? What is the interest rate? Okay.
There's
How
different
much are the
requirements.
taxes? How much are the insurance?
Yeah.
But again, I honestly, we're going deep. Like I usually don't go this deep, even in a lot of my conversations. But here's a good equation to know with today's interest rates, which are kind of like high fives, low sixes, depending on the day. But we've thankfully been in like a stable range for about 4 or 5 months now. Super grateful for that because the last couple of years were so volatile. But here's the equation: every $10,000 you spend or don't spend will change your mortgage payment about $60.
Boom. There it is. That's the clip. Clip it. It's all over. Tracy Everman. She said it.
Same thing is true for down payments. Every $10,000 that you put down on
Yeah.
the house is going to change the payment by how much?
50.
$60.
60, 50. Yeah. Yeah, that's true.
60. So it's like, do you want a payment that's $60 higher, or you want to keep 10 grand in the bank because it's
Oh, yeah.
liquid?
Oh,
so
yeah.
those are things to consider.
I also like, just speaking of like, when people take money into big proportions, right? $10,000 is a lot of money.
It
and
is.
And I spend all this just to save 50. I also love it when people come to me and they're like, Rob, I'm paying for more than the house after 30 years. And, you know, you're looking at it, you're like, yeah, that is a lot of money you paid in interest, but I want to put you in a rental for 30 years. And let's see, you know, how much money did
Can
you
we
pay?
agree? Well, you
Yeah.
know what the interest is on renting a property?
100%.
100%.
Yeah, 100%.
100%.
I was gonna say
interest.
zero.
No,
Yeah, sorry, the
but then
opposite.
but then your appreciation.
Oh,
I'm gonna buy it, or I'm gonna pay for it, and then at the end, what do I have? Big goose egg, still a big fat zero.
Well, yeah, and I don't want to go down a rabbit hole, but a friend of mine, he bought a house, and he was probably in his mid-20s, early 20s, bought a house in 2015.
Okay.
Yeah. And his boss, or no, it might have been to like 2017 or something, but his boss, we were like, hey, why don't you have a house? He's like, you think I want that mortgage payment? Right? But he had a rent. His rent was just as high. And then my friend hit 2022.
Oh yeah.
Sold his house, bought a bigger house
After
with the
5
equity,
years.
and then bought that house, big, like scary mortgage payment, and then he sold that house in 2025, bought an even bigger house, right? And unfortunately, you look at the other individual who had been renting that entire period of time. Now,
Go ahead.
I'm
And then I
not
gotta
trying to
throw something
advise
out to
that.
the
I'm not
audience.
trying to say like, don't treat housing like the casino, right? You know, you
No,
he did get
no.
lucky, but it is crazy to look back at those 7 years at the two individuals, and one person is walking away with hard-earned money from what
Could
he
be hundreds of thousands after
hundreds
7
of
years.
thousands.
Yeah.
Oh, I'm sure he probably earned maybe $200,000.
Well, because the one thing you get when you're paying off a loan, I don't care what kind of loan it is you get principal.
Oh yeah,
You're borrowing
equity,
$200,000.
principal, same things. Yeah.
Well, yeah, you're borrowing $200,000, but then eventually you're only going to owe $195. Then eventually you're only going to owe $185 as time goes on. You know, so I always tell everybody, and again, we could go for 3 hours, listeners. We're not going to do that to you, by the way. But you know, you get principal and you get appreciation. You know, which the more the house is worth and the less you owe, there's your equity.
Yeah.
You know.
No,
It's-
I get you completely. And it's almost like the same idea as thinking like that Robin Hood app. Every penny counts, right? You don't realize. Do you know what I'm talking about, Robin Hood? It's just like
I'm not
extra.
that old. Come on.
I don't. You looked at me like you were like,
No, I know Robin Hood.
yeah, yeah, but it's the
I
same
think
idea.
I have one. I've got the app on my phone. I think I did
Who
the
knows
pennies
how much
things.
money you have on
I
it.
haven't looked at it in
Yeah.
years. I should go check it out. Anyway, so the Robin Hood app, yeah, pennies.
No, I was just saying every penny counts, and you don't realize it after you look back 7 years. You know.
Well, and here's the thing. Like my thought on that, you know, real estate is not a quick investment. It's not,
No.
hey, I'm going to buy a house and sell it, make $50,000. No, that's not going to happen. I tell everybody, again, trying to keep things simple, is you buy and you wait. You don't wait to buy.
No. I agree with you.
know?
And I like that doesn't mean always buy. You know, if you're in between jobs or you're not confident in what you want to do for your career and stuff, or you might move to a different location or you're starting a new relationship.
absolutely.
Those things are reality checks.
Yeah.
But I find I try to hold my tongue. You know, I try to hold my tongue when I have somebody come to me and they're like, yeah, I'm just going to keep renting for another year. And they've been with their job for 5 years.
And they're paying $1,500 a month. They're like, that's $18,000.
They're doing great. They got consistent income. They got they could be single. They got a healthy relationship. But I'm just like, even if you don't plan on living here, buy something with walkability.
Yeah.
Make sure it appraises at least competitively, and then
Yeah.
rent it out. You
the
created
house
your own-
hacking.
you just created
We
your
love
own little.
TikTok for that, don't we?
Yeah, probably. I
No,
guess
that's.
I mean, but
there's
yeah.
a lot to be said with
there's more reason
buying a
to
house
buy
and turning
a
it
house,
into
yeah.
a rental. Yeah.
Yeah, there's more reason to buy a house than there is less, and that's the objective
Mm-hmm.
of these podcasts or anything, is to educate the buyer that you're sitting on potential equity just by being you.
Yeah.
Right? It's crazy.
Yeah, and everybody has to have a roof over their head.
Yeah, and
Is
I
it
guess
going to
I'll-
be somebody else's or is it going to be yours?
Yeah, and I guess I'll
You know?
close with this thought with one other thing. I have a friend. He was talking about how somebody was bragging they had $60,000 in his account, and he's probably watching this right now. And he's like, but anyways, he's like, $60,000 is a lot of money. What are you doing
is.
working here? And I was like, you got to understand, buddy, $60,000 isn't a lot of money for you, because I was like, you have a stable job, you have supportive family, you're single, you're young, and you're good looking, right?
Right.
I was like, go buy a beat up house in a nice area.
Yeah.
Spend the next 2 years painting it, loving it, doing what you need.
Give it the
live in if you
TLC,
want.
yeah.
Yeah, live in it if you want, or sell it in 2 years, and you will be looking at $60,000 as not
Yeah.
that much money.
You want to hear a really fun statistic? Because,
What?
I'm like an economics dork and I follow charts and graphs and all that stuff.
Yeah.
It has been stated that if you buy a home in your 20s, instead of waiting to buy a home in your 30s,
Yeah.
that you will actually create about $84,000 more wealth.
Oh, I agree.
Because of what? Because you're paying down principal.
Paying down
and you're
principal.
getting appreciation. You have
Agreed.
equities at a younger age.
And it's on top of that. 401ks are very, very important. I'm not downing 401ks. I'm not downing stock investment or anything like that. But on top of that, when you're putting money towards a 401k, it's gone. You never see it again. When you buy a house, you can play with it too.
Yeah.
You know what I mean? Don't play too rough. But
Yeah.
it's like, you're buying your own thing. And
Yeah.
this amusement that you're experiencing and everything, I also have to remind my buyers sometimes, the ones that are really, really, when they get into the idea of like pure equity, pure investment and return on their investment. I was like, remember, guys, you're sacrificing money because this is a toy. This is an
Yeah.
adult toy. Don't forget to sacrifice that money for the conveniences and that kind of stuff too.
Yeah.
Yeah, and you buy and you wait. What were you going to
Especially
say?
for like first-time home buyers,
Uh-huh.
right? When we're talking about, buying a more rundown property and fixing it up, I feel like there's an element of different standards, right? And to get into your first property, lowering your standards for that property and building it up.
Well, yeah, because you're not. Does anybody buy a house and stay in there for 30 years
Well, right.
anymore? Nobody does. Life is too.
exactly.
Life's too much in motion.
And if you wait around for the perfect house,
It doesn't exist.
It doesn't exist.
It doesn't.
And you're going to be waiting longer.
I've had people like that, because there's like an existing home, then there's new construction, then there's custom construction. Like where you put together every single line item.
Oh,
You
yeah,
choose
that's
every
expensive.
every little handle for every little cabinet. And I kid you not, you could build a custom home for $900,000. And what are you going to do? You're going to close on it, walk in the house, and then the first thing you're going to say is, gosh, you know what I want to do next? There's no such
yeah.
thing as a perfect home.
A comedian just he had a huge skit. I forget his name, but he was just talking about how we're a species of wanting. We love to want, but when we get it, we're like, oh.
Okay, what's not? Yeah, the dopamine. Hello.
Yeah.
All right. So got a lot of great information from you. And like you said, we could sit here and talk for hours.
Yeah.
Well,
going
please
into-
have me back.
into
Sometime, maybe
details.
next year or whenever.
Yep.
You say when, I'll be here.
Absolutely. I have
Tomorrow at no.
one last question for you to kind of end it out.
Okay.
So for those that are looking to buy within the next let's just say 6 to 12 months,
Mm-hmm.
what is the best what should they be doing? What is the best piece of advice you can give?
Oh my gosh, the list is long, but I'll keep it simple. So you got to make sure you got stable employment.
Okay.
Okay. keep as much money in the bank as possible.
Quickly put a number on that stable employment.
Well, I mean, preferably if you're on your job for 12 months or more.
And
You
you got to
know.
be able to prove it on your tax return. technically.
Well, not we pay stubs, W-2s.
True.
But we want
Touche.
consistency.
Consistent.
Is
And
it
you said 12 months.
stable? Having 4 jobs in 12 months is not stable, in my opinion. But, so stability with your employment. Okay,
Yep.
you don't have to be making a ton of money, but if you're working for the same employer, that shows stability. So that's 1. 2, really have a budget. Hello, meaning like, what do I spend at Amazon? What do I spend on coffee? What do I spend at the grocery store? So you can actually save money. Anybody out there, you need a simple budget, I can send it to you.
Yeah.
Save as much money as possible. And then honestly, talk to a lender. You know, a lot of people, and you guys know this in your industry, a lot of people go to the realtor first, which is fine. You guys have access to the houses. Okay, but guess what? Most people, you can't get the house unless you have the money. So talk to a lender, talk to a loan officer, mortgage banker. So you have so many different
That's
titles.
one of the first things that we recommend.
Yeah,
Yep.
To do.
absolutely. Because like, let's just say the credit score needs a little work. Okay, you know, we got to improve that credit score. Guess what? We'll give them the advice to do it. Or hey, you need to save up a little bit of money. Yeah, I can get you down payment assistance, but you're going to have some closing costs. You might need to save up a chunk of money. This time of year, a lot of people are getting their tax refunds, and that they're like, time to buy a house, you know,
Yep.
and it
Time-
works.
Time to buy anything.
It's great, you know. So yeah. So I would say just make sure your income is stable. Make sure you're able to save, you know, a little bit of money on a monthly basis, and then talk to a loan officer or a lender to see where you stand. Because if you need a little bit of work, especially if
Yeah.
you're in a lease situation where you've got to be out by April 30th, you
Yeah.
need to be talking to a lender at least 90 days.
And it is
prior to
funny too.
looking.
Yeah, one of the biggest qualifications we have for our buyers is we're like, you know, we need proof of funds if you're paying in cash or if you're getting a loan. And a lot of people don't realize, you know, just talking to a lender real quick on the phone, getting a pre-qualification is nothing. I always say, you know, when they ask me for advice on, you know, can I afford this? Can I do this? What about this and that? I was like, unfortunately, I have to get under your hood, and I can't. So I'm
Yeah.
going to introduce you to somebody who's qualified to get under the hood, really see if this car runs, right?
Right.
And then see how long it's going to run, see what parts need work and things. And
Yeah.
when you say that you give advice or game plans on how to better
Yeah.
your credit, better your expenses, your debt to income, it's not only, I have individuals that don't only do it just to get a pre-approval. I have individuals that get pre-approvals, but they just don't like the way the numbers look. And then you will happily set them up a roadmap
Yeah.
on, you know, how to better those numbers,
You
how to
gotta,
make them look
you gotta
prettier.
plan. So.
Cool. Chad, what else you got for us?
Again, thank you very much
Thanks for having me.
for meeting with us. I think this was great.
Useful. Yeah.
I hope everybody out there got something. You got what you came for. You know, just a
Yeah,
little bit
sadly-
of advice, and don't hesitate to reach out.
Sadly, they probably didn't get everything they came for, and that's just how this stuff is.
Yeah, that's why you got to do
gonna
another
walk
one.
away with, we're going to put Tracy Everman's contact information on here in the notes or something like that, so you guys can find her if you want to dig into her brain and the way it functions even more on all these questions and ideas we've gone over. It's just super important to talk to somebody like Tracy just to better understand even what you're driving, right, when it comes
Yeah.
to your ability to buy. And then, of course, always reach out to us if you want some, you know, professional representation when it comes to realtors, real estate agents, and your buying or selling needs. But I think we're good to wrap up.
Let's wrap it up.
Thank
Thanks
you
for
so much,
having me,
Tracy.
guys.
I'll
All
see you
right.
later.
See ya.
Bye-bye.